Welcome to the What to Watch video update. This is the last video that I do each weekend where I go through and look at all of the charts, both daily and weekly charts, and pick out those that seem to really be saying something right now. And then I put them into three categories: those that are positive, and the list this week is pretty short, those that are negative, and that's a very long list right now, and then those things that we're just watching just to see how they have an impact on the S&P 500. This is being prepared for Monday, April 7th. First, the very short positive list, and this is still holding up for right now. What you see here is the QQQs, that's the NASDAQ 100 ETF, with a ratio of the small caps. Now, they both have been under a lot of pressure, but small caps have been under even more pressure. And so that's why we're seeing this ratio holding up. The Qs are outperforming, even though they both have been going down. As long as we're above this blue line, we're still seeing things more positive for right now. So it's something to latch on to, at least for the time being. Also, now this is actually negative. What this is another ratio of the regional banks, the smaller banks, to the financial sector. And we need the financial sector to really stay strong and do well in a positive environment. That's why I watch it, because if it's really starting to show cracks, then that is a real concern. Now, this is negative because we do a ratio between the small banks, the regional banks, and the financial sector, and you can clearly see that it's down. One thing that I did notice, though, in Friday's session, everything went down, but we closed up off of the low in Friday's session with this ratio. So that's why it's on the positive side. What we're seeing is across the board negativity. Sentiment is very low. People were getting out on Friday just to get out. They didn't care. They just wanted to be done with being in the stock market for right now. And that could have been a type of capitulation. And that will often signal some kind of a bottom. Now, we don't know. Are we going to get a bounce out of this? We could. But then what is the quality of that bounce going to be? We bounced before, went back up, and then came down and went even further down from where we were previously. So we're right near that point where we're, at least with the S&P 500, on the border between a correction and going into a bear market. We're getting near that 20% level. And so possibly this week we'll shed some light on what's going to happen there. But this was one of the few areas that I actually saw improving going into the close. You can see the number over here. Now it was still down, but it closed up off of the low. I didn't see that in the S&P. It closed at its low, and pretty much all the other indexes closed at their low as well. Another thing is a ratio between the NASDAQ 100, which is growth, and the Dow, which is considered to be the best of the best stocks, the blue chip stocks. Well, there is some growth in there, but they're considered to be the highest quality stocks. And even though this ratio is coming down, we're still not really falling below this red line. When we really topped out before, this was the dot-com boom and then bust. And then it took us a long time to get all the way back up here. And we hit this same ratio at the end of 2021. And then we fell down as we were going into the bear market of 2022. Then we were coming back up. And so far, we've been hanging out around this high ratio level. So this, even though it's weakening, is still looking okay for the time being. Then we look at a 10-day simple moving average of the advancers minus the decliners of the S&P 500, and that plots like an oscillator. We look for an extreme positive or negative reading. Even though we were really negative this past week, we just barely dropped below the zero level. We're not getting a real extreme reading with this. Now, that can be positive in the fact that this is holding up. That can also be kind of negative because that means that we're seeing rotation. The market itself has been holding up. When we look at some of the internals that I'll show later, the advanced decline line, the new highs, new lows, it's not because money has been coming out of the market. It's because money's going from one part of the market, growth, into another part of the market, value. And we're seeing this holding up fairly well. Now, we did see some capitulation selling on Friday, and that's giving us some extreme negative readings. Even though this is below zero, that's considered negative, but it's not really going down like some of the other charts that I'm going to show you here in a bit. Now, that's it for the positive side, all I could come up with. Now we have a pretty long list on the negative side, but you're going to see kind of the same theme going through all of these different charts. First of all, this is just a daily chart of the S&P where we're coming down. We broke below these dashed lines. These are previous pivot levels. which often act as support when we're falling, or if we're going up, they might act as resistance. And just been coming down. One thing that we're keeping an eye on is this blue line is a 50 period moving average. As long as it's above the red line, which is a 200 period moving average, we are still in an uptrend. And we've been in an uptrend since early 2023. It's hard to see in here, but that's when we crossed over positive. If we cross below this, that means that the longer term trend has now switched to negative. So we're just going to be keeping an eye on that, but it's still positive for right now, but it's negative because you can see how we've just been falling off a cliff. We gap lower, fall, and then if Thursday was bad enough, Friday was even worse when China retaliated with some of their own tariffs thrown back at the US, produced an even bigger gap and an even bigger decline and a massive increase in volume. Now, that can mean there's a lot of conviction behind the selling, but a lot of times when we are going down and we're really going down hard and we see a massive increase in volume, that could also mean capitulation or the possibility that we're either at or near a bottom. The condition of the short-term trend is really weak right now. I measure the short-term trend by 20 periods. This is a double and triple exponential moving average. The lines are going down and prices below both of the lines. So yeah, this is clearly negative. The 50 period moving average is what I use for the intermediate term. And we're below the lines and the lines are going down as well. That's negative. These are all different moving averages, both simple and exponential, plotted on the same chart. A simple moving average would say, let's take 20 periods. It would count up all those 20 periods and then divide by 20, where period number 1 and period number 20 get the same amount of weight. An exponential moving average, it moves quicker and it gives more weight to more recent prices, which there's some logic behind that. But most folks end up using simple moving averages. And over time, there's been some tests and research that's been done saying that actually simple moving averages are a little bit better because they move slower. And the slower you go in the stock market over the long period of time, that tends to work more to your advantage because now you're not just doing everything as quick. You're maintaining a little bit of patience. But this chart is not very good looking right now. We're below all the moving averages here, and the shorter term moving averages are just water falling down and crossing below the longer term moving averages. So, yeah, this is a pretty ugly looking chart right now. But we have become pretty far away from the moving averages. The boom indicator measures current price in relation to the 20 period moving average, 50 period moving average, and the 200 period moving average. When we get down below this red line, we're getting way far away from the 20 period. We're getting way far away from the 50 period, and we're still not all that far away, but still not looking all that good with the 200 period moving average. Now, the reason this is called the boom indicator is if price goes in one direction or the other, it has a tendency to boom, go back to the indicator. It's like a magnet or a rubber band. It'll pull price back. Since we're below these moving averages, if that rubber band or magnet type of effect starts to happen, that could actually pull price up and get it back closer to the moving average. I was in a webinar a few years ago. I used this for years, but I just never gave it a name. There was somebody that was demonstrating this in one of the webinars, and they just went, boom, go back to the moving average, boom, this, boom, that. And so I just ended up calling it the boom indicator. That's where it came from. All right, then we are now in correction territory. We are 17.42% from the all-time high that was set in February. If we drop on a closing basis more than 20%, that means we're now in a bear market. And that's negative. A bull market is positive, a bear market is negative. So we're keeping an eye on this. We were concerned that we were going above the 10% level. That means that we're into a correction, and that's where we're at right now. But if we go above 20%, that changes things and makes it even more negative. Sentiment. I don't even know if this chart is capable of going negative. It probably would if it could. But my goodness, we usually freak out when we're getting a reading at around 25. This just keeps going down and down and down. We're getting a reading of 4 right now. My goodness. You can't get much more pessimistic than that. And we use this as a contrarian indicator, but we've been below 25 for quite a while now, and it's just been camped down here. And so we're thinking that at some point, all the fear is going to be everybody. That means all the sellers have done their selling, and now people start coming in and buying, and we start to bounce up from this. And also the Investors Intelligence Survey. These are folks that give recommendations. For 3 weeks now, they've been at one or below. We got a little bit above one a week ago, but this is a very low reading. And when they get really low like this, we tend to use this in a contrarian manner as well. Also, individual investors. The only problem is we've been down at this extreme negative reading for 6 weeks now. Usually we just come down here, everybody freaks out, and then we bounce up out of that. That's not what's happening. They've come down and are negative and have remained negative for 6 weeks. And so we don't know if this still has more to go or if we're actually getting to a point of capitulation. The VIX just shooting up right now, really going up here. We're at 45 right now. We get concerned when the VIX goes above 20. That's when it's showing a lot of fear. We get even more concerned if it goes above 30. That happened after Thursday. Well, we closed at 45 after Friday. So this is quite negative. This other spike, this was the end of the world day last summer when everybody was freaking out and the VIX went up to 65 intraday and then closed well off of the high. That only lasted for a few days. This is a different context. Things are happening different now than were happening back then. We have a new administration. There's all these changes going on that weren't going on last summer. So you could look at this and try to make a comparison, but you also have to know the context of why these things are actually happening. Now, Tom Bally, who is connected to stockcharts.com, and he's also connected to earningbeats.com, he did some research a while back, and he showed that on an annualized basis, when the VIX is above 20, that's when we see negative annualized returns. Well, my goodness, we're at 45 right now. Now, we could still go up more from where we're at right now, but this is quite negative. We need the VIX to come back down. Once we get below 20, then we start to see positive annualized returns, but we're not there right now. And we're going up pretty quickly with the VIX. It's really shooting up. And so I use a MACD, which is a momentum indicator, and that's just showing you what we can already see in the chart that yes, the momentum is up for the VIX, and that's negative for stocks. But maybe we're going up a little too quickly. We use a short-term RSI, the relative strength index, based on 9 periods. When we go above 70, this is an oscillator, and it gives us an overbought condition, which you have to look at that in reverse because the VIX going up means stocks are going down, and we're above this 70 level. Now, we could still go higher than where we're at right now, but a lot of times when we hit something like this, that's usually about the point when the VIX will top out and start to come down, which means stocks are going back up. But we have no guarantee that we're at that point right now. This could still go up even more from where it's at. Then we look at growth versus value, and this is what we've been seeing played out over the last number of weeks. We've been seeing the red line, which is value, above the green line, which is growth. In a more positive environment, we want the blue. Did I say green? I meant blue. We want the blue line above the red line here. That means that growth is outperforming value. Well, they're both really going down now. Everything got hit on Friday, but you see where they're, even though they're on different scales, you can see where they're getting a little bit closer to each other. Are we seeing some kind of a capitulation here? Now, we don't have really any confirmation on other charts that may suggest this, but we're going to be watching to see if we do start to bounce. Is the blue line going to go up more than the red line? That would mean there's more growth coming back into the market. Now, this is kind of like that. This is an S&P growth to value ratio, and it was down in Friday's session, but it actually performed a little bit better over the last couple of days. Has value kind of ran its course, and is growth going to start coming back in and looking stronger? We've had a number of false starts along the way. It looked like growth was really improving, and then boom, we go down. Growth was improving, and then boom, we go down. Value is what the market gets into when it becomes more defensive. Growth is what the market gets into when they're more offensive. They think the market's going to actually go up. So we're watching these ratios pretty closely. We also look at an end of day chart with the small cap growth to value ratio. It's still in an uptrend, but we've spent a lot of time under this 200-day moving average, and we actually went down a little bit on Friday. Mid caps also below their 200-day moving average, even though it's still in an uptrend. This is the most important one for what I follow, the S&P 500. We're actually showing some weakness here, and we're below the 200-day moving average. The longer we stay down here, the more we might see a death cross with this ratio. We also look at growth versus value by comparing a couple of ETFs. You can see when this is going down, that means growth is underperforming. And then discretionary to staples is another kind of form of growth to value. We're really going down here too. And this is just showing that the market is becoming more defensive, getting ready to decline. but we don't know if that decline is over or if it's just getting started. Then other growth to value ratios that we follow, the Qs to S&P, negative. We actually saw a little bit of improvement with discretionary to the S&P. That's Tesla and Amazon are in discretionary. And large cap growth versus large cap value, that is still looking negative. We're going down with the large caps, mid caps, but the small caps showed a little bit of improvement, but they're still at a declining moving average. So it's not positive. We look at a risk on versus risk off ratio, and this is going up. That means the folks out there are more risk taking with the stocks that they're buying, and they think that we're going to go up, and we see this ratio going up. Well, we've been coming down as folks have been becoming more risk off. They're getting into more defensive stocks. This is also a very similar measure here. High beta means that they outperform when we're going up. Unfortunately, they also outperform when we're going down, meaning they go down faster. That's why we're seeing this really going down when we compare it to low beta. These are the more conservative, boring stocks. They're actually outperforming right now, and that's why we see this ratio really going down. Now, this is positive and negative at the same time. The advanced decline line, as we've been coming down with the S&P, the advanced decline line's been going sideways. It hasn't fallen apart, which suggests we're seeing rotation from growth to value. Well, the reason why this is negative, we crossed below the moving average on Friday based on volume. This had been holding up also as we were coming down. You would expect it to fall below the moving average. It didn't until Friday. Now this is looking like it could be more capitulation, and it's actually turning more negative. We're seeing that same thing here. New highs, new lows. It had been holding up. Okay, we were trying to show a little bit of recovery here, but look at the massive amount of new lows that were set in Friday's session. That's quite negative, and we're going down with the 5-day moving average and the 10-day moving average. And accumulation distribution. This was a very stubborn indicator because as we were coming down with the S&P, the line between positive and negative with this indicator is whether we're above or below the moving average. Well, we were coming down, but we kept staying above for the most part, above the moving average. And that was really causing some confusion as we were rotating from growth into value. Well, in Friday's downward move, we actually fell below the moving average, and that's turning the smart money indicator negative. This is smart money indicator number 2, the Chaikin money flow. The red line's going down, and we're turning negative with the histogram. That's negative. And we're declining below the midpoint with smart money indicator number 3, the Chaikin oscillator. So all 3 of our smart money indicators are now negative. The vortex, the red line's going up, the green line's going down. Red means selling, green means buying. We're negative. And now we look at the condition of the trend in a number of different time frames. This is the short-term time frame, which is days to weeks. And we're clearly negative because the red line's going up and the green line's going down. Now, this is also a strengthening trend because the dark line that you see here, that's the ADX itself, and it's going up. And then I plot a moving average on here to give it some context. When we're above the moving average and going up, that means the trend is getting stronger. When we start to come down, we're still trending, but it just means the trend is getting weaker. Well, we're starting to show a stronger trend in the short term, and it's negative. Now, one thing to be aware of, this dashed line here at 40, when any one of these lines, whether it's the black line, the red line, or the green line, gets above 40, it doesn't mean it's going to stop, but it means we watch it a little more closely because you can see the green line got right up to 40 here and then came down. The red line got right up to 40 here and then came down. Well, we're above the 40 level here with the red line. Maybe that means we're hitting some kind of capitulation. Now, we look at the intermediate term, which is weeks to months, and we're also above 40 with the red line. We're also showing a strengthening trend, and the green line is going down. This is negative, but we're watching this red line. And we look at a weekly chart. This is now a confirmed trend. We've crossed above 20, and we're above the moving average. This means it's a confirmed strengthening trend, and it's negative because the red line's going up and the green line's going down. Now, we're not quite there at the 40 level on the weekly chart, and we don't necessarily have to get there. But when we get around this point, this is when we think maybe we're kind of overdoing it. Because you can see other times when we had very high readings like this, they would turn and come down, and we would typically see some kind of improvement in the market. We're just waiting to see if that's going to happen this time. Then we look at some rate of change charts. This is short term. This is taking Friday and then going back 5 periods and comparing the close on each one, and we're extreme negative there. Then we have a rate of change going back 10 periods. That's also short term, a really extreme negative reading. Then a rate of change 20 periods. This is short to even intermediate term, a real extreme negative reading. And then a 50 period rate of change chart. This is also extreme negative. We usually don't see all of these giving extreme negative readings at the same time, but we're sure seeing that now. And so this could mean short-term exhaustion to the downside, but we have to see confirmation with price actually going up, not just guessing that it's going to go up, because about the time you think it's finished going down, a lot of people thought it was finished going down on Thursday, and then Friday happened after that, and we fell a whole lot more in Friday's session. Then looking at some rainbows, this is a short-term rainbow going from 10 periods up to 50 periods with simple moving averages. This is clearly in a downtrend. All the lines are coming down and prices below all of the lines. We look at the intermediate term trend going from 50 periods up to 100 periods below the lines are coming down. Then we go from 50 periods up to 250 periods. This is long term. We're falling below the rainbow, and we can see the top end of the rainbow starting to roll over. If we stay down here, these lines are going to continue to roll over, and that's going to turn the long-term trend even more negative. Now we're going down. Now this held up too. This is the summation index for the S&P 500, but we're going down based on price. We're actually going down a little bit more based on volume. But as we were coming down, this was holding up fairly well. That suggests rotation. This is an indicator that's derived from the McClellan oscillator, which looks more internally to what's happening in the S&P. And that was holding up fairly well. And we were actually going up for a few days here before we started to turn down in Friday's session. And we're going down with the swirling trading oscillator, but not with a lot of velocity right now. We came down based on price, and we're just starting to roll over here based on volume. To see this massive decline here and just to have this blip over a little bit, it's picking up some strength inside of the market, but it's still negative for right now. Parabolic SAR, negative when the dots are on top. And here's a weekly chart of the parabolic SAR. We're also negative with the dots on top here. And momentum is now pretty much negative across the board in the short term, intermediate term, and we're rolling over here in the long term. After it looked like we were really making some strides at improving, well, we were looking okay until after Wednesday. And that's when the announcement of the tariffs came out. And it was a lot more radical than what the market had anticipated. And that's why we're seeing this big downward move here. And that's turning all of our oscillators down. Then the Kopek curve, another momentum oscillator, had been positive. Now it's crossing over negative. And the percent B indicator, and I forgot to include a chart. We don't see this very often. This is the daily chart, and these are the Bollinger Bands, and this just means we close below the Bollinger Band, which tends to not happen very often. The chart that I forgot to include here is a weekly chart, and we're seeing the same thing. And it's even more rare to see an extreme negative daily reading and weekly reading at the same time. That could also suggest short-term exhaustion to the downside. And this is a long-term oscillator. I usually don't show this in the daily videos because we don't get very many signals from it. Back in the early part of March, we crossed below the red line. This is called the special K, and that means the long-term momentum is now switching to negative. I don't have the chart, but the weekly chart is still positive, but it's starting to roll over. Then we look at point and figure charts. This is a daily point and figure chart. Lots of O's means lots of selling, and we're seeing a descending triple bottom breakdown, which was generated after Thursday's session, and then we just added a bunch more zeros after Friday. This is a weekly chart, a descending triple bottom breakdown. That was generated way back last Monday, and we're just adding more and more zeros. So again, this is not something that we see all that often, where the daily and the weekly point and figure charts are showing very similar things at the same time. Usually there's some separation between the two. Then the bullish percent index below 50 and declining and actually getting extreme when we drop down below this 30 level. We could still go lower, but this is at the point where we're looking at some kind of short-term exhaustion. Then, just to give it a little more focus, we have the NYSE bullish percent index also becoming extreme negative, and the NASDAQ 100 bullish percent index very extreme negative. We've seen lower readings than this, but this really came down. It went in just a couple of days from being positive to downright extreme negative. Then the percent of stocks in the S&P above their 20-period moving average, extreme negative. This could suggest short-term exhaustion. Also, an extreme negative reading with the 50 period moving average study, the 100 period moving average study, and the 200 period moving average study. We don't usually see these all lining up at the same time like we are now, especially when you compare it with some of the other charts that I've been showing you as well. This is a long-term trend line going back to the 1987 crash. We're starting to drop below that. And since that's a little hard to see, this is a further blow up of that same trend line. We're dropping down here where we had been above this for quite a while, going back to early 2024. Now we're starting to test this again. And Fibonacci retracements, this goes from the low set a year ago in April of 2024 to the all-time high set in February 2025. We were coming down here, and this was trying to act as either support at the 50% or 61.8% retracement level. Well, we broke through that, and we're starting to break down below the 38.2% retracement level. But this is considered to be a shorter-term Fibonacci retracement chart. This is longer term. This goes back to the low set in October of 2022 to the all-time high set in February, and we're starting to break below this 38.2% retracement level. So this is longer term negative. A trend channel going back to 2009, we started to bump into the upper end of this back in December into January, and that's when things really started to slow down. And now we're coming down and we're actually hitting the midpoint right now. This could end up acting as support, but you can see other times we fell below the midpoint, so there's nothing really magical. Here's a time when we did fall back in 2016 right to the midpoint, but we'll see if this ends up combining with some of the other extreme readings and support levels that we're seeing, see if we can get a little bit of a bounce from this. Then this was kind of discouraging too. We were watching this pivot point. This is a weekly chart of the S&P. We had held on to this for a number of weeks. Well, in Friday's session, we came down. But the positive side is we just came down to this S1 support level. We didn't go below that. So this is a support level that's holding, even though this pivot point has been broken now. Maybe the market will find some support at this point. And then we look at a ratio between the SPY, which is the ETF for the S&P 500, and then staples. Staples are toilet paper and toothpaste, things that people have to have no matter what's going on with the economy. And we're seeing a breakdown over here. Well, the last time we saw a breakdown like this was at the end of 2021 going into 2022. Now, this ratio actually started to go down, and the S&P itself set its all-time high in January of 2022. This started to break down in late 2021, and we could see this happening at that time, and that was getting us more geared up. So the breakdown actually happened before the SPY, which is the ETF of the S&P 500, actually topped. Is that what we're seeing now? Because we're really rolling over. This is going down. The S&P is really underperforming staples, toilet paper and toothpaste. It could be that that's what's happening. This could get set to change things more negative. We just want to be aware of this because this usually happens before things really start to fall apart. Okay, and we're looking more negative here with the advanced decline line. With all of the different indexes, the NYSE common stock, we fell below the moving average on Friday with the S&P 500. It had been holding up a little bit better. The mid caps and the small caps, all of these indexes are below these moving averages, and that's negative. The Dow just getting hammered in it, but it's the best looking index right now. I rank this in another video called the deep dive video. I look at the Dow, the S&P, the NASDAQ 100, mid caps and small caps. For 2 weeks now, the Dow has come in first place. Now it's coming in like at 40 on a scale of 0 to 100, but the other indexes are doing even worse. We've got the mid caps down into the small caps, they're down into single digits. They're really looking bad. So this is naturally negative, but this is kind of the best looking of the negative right now. But we did fall below this S1 support level. We're well underneath the 200-day moving average. We fell below this S2 support level on an increase in volume. Is that some kind of capitulation that we saw on Friday? Or are we just getting started with continuing to go down? The NASDAQ getting really close to a death cross. We've fallen now more than 20% from the all-time high or the recent high that was set. The NASDAQ is now in a bear market when it's down over 20%. NASDAQ 100 came right back up to the 200-day moving average and has been falling right around down to this S2 support level. We'll see if that ends up providing some support. And here's a weekly chart. Now, another thing that I noticed here, looking at these thick red black bars here, these are a week each. Notice how we're coming right back to this recent low. Now, is that a support level that could hold? It is a support level, but are we going to be able to bounce up from that? We don't know that. We just want to be aware of this right now and just be watching that. And here's the small caps. Downtrend, really looking bad, just slicing through support. Here's another small cap index, the Russell 2000, very negative, extreme negative with the RSI. Death cross, downtrend, momentum, negative, just slicing through. Not looking very good. Mid caps, negative trend, just cutting through support really quickly here. Financial sector broke below its 200-day moving average. Now, even though I showed the ratio between the regional banks and the financial sector, this is actually making that chart look a little more encouraging because you notice the financial sector closed right at the low. That ratio closed well up off of the low. And there's another chart I want to show right here. The bank ETF. We want the banks to hang in there and to stay positive. Notice how they were down, but this was the area that closed up off the low on Friday. And that means somebody's in there buying some banks on this weakness. That could really help the market if it continues and if other parts of the market actually catch some fire and start to go back up. Then the Wilshire 5000, a broad market measure, just falling further below its 200-day moving average. Another broad market measure is the total U.S. stock ETF, well below its 200-day moving average. The FANG index, these are the big stocks, Facebook, Apple, Amazon, Netflix, Google, Nvidia, showing a lot of weakness here, closing pretty much at the low. Semiconductors, a huge part of tech. We crossed over positive, which took us out of that bear market in 2022. Now we're crossing over negative. So this is giving us some more reason for concern right now. And I have a lot of different semiconductor charts, but they're all showing the same thing. So I figured I would just show this one. And then we look at a ratio between the semiconductors, which are negative, and the tech sector, which is negative. And when this ratio is going down, that means the semiconductors are doing even worse. And that's quite negative for the market. Then robotics and AI, that's what everybody's all the rage about. I've been really involved with AI lately, but look at how this ETF is just going down the tubes right now. And then we look at staples, toilet paper and toothpaste to tech, which is growth. When this ratio is going up and we're seeing a recent golden cross here, that means staples are outperforming, and that's more of a defensive market. Then we look at the S&P 500 with 3 to 7 year bonds. When we're up in this area, that means the market is anticipating a soft landing, meaning no recession. Well, look where we're at now. They're into this hard landing area. And the longer we stay here, the more the market is going to be anticipating that, yes, we will likely go into a recession. Now, we could come out of this pretty quick. We've had this threatened before and it's recovered. But if this continues to look bad, then that's going to cause more concern. And we look at the S&P 1500, another broad market measure with short-term bonds, and now you're going to see a lot of the same theme here. We're just going to see the stocks are really underperforming short-term bonds. Then we look at another broad market measure. We look at 3 to 7 year bonds. Stocks are underperforming. The tech sector underperforming 3 to 7 year bonds. The NASDAQ weekly chart falling further below this trend line going back to 2009. The Qs to the Treasury bond ratio here, the Qs are really underperforming. Home construction, this was one of the first areas to turn weak. It actually started to show some weakness in 2024 in late November and into December. We saw this happening first, and then some more problems started to develop after that. But this is actually looking quite negative. And then we do some measurements here with those stocks that are mid caps that are above their 50-period exponential moving average. Now, how we use this is like an oscillator. We look for an extreme positive or negative reading. Well, look, we're getting an extreme negative reading. We're not there yet with the S&P, but we are here with the mid caps. So this might suggest some kind of a bounce. And we're also there with the small caps. We're below this red line, meaning we're getting extreme negative here. We're not there, and we could stay a while down here, but we're not there with the S&P 500 or the large caps or tech. But this, at least it's a start. We're starting to show some extreme negative readings now. Then we look at the S&P to utilities ratio, though. When this is going down, that means the S&P growth, mostly, it's growth and value, is underperforming the utilities, which tends to be more of a value area. Now, you could make a case that utilities are growth because of all the needs for AI and electric vehicles and all of that. But the tradition has been that utilities, this is what widows and orphans get into. And when this is going down, that's negative for the S&P. And then staples again to the S&P. When this is going up, that means staples are outperforming. It looked like we had spiked here and we were starting to go back up, and then everything just fell apart again. And then we look at the semiconductors to Dow. This is ultimate growth to ultimate value, and this ratio, but this has been going down for some time. But it's not falling off a cliff, although it is declining, though, a lot more than it was before. So this is still negative, but not falling off too big of a cliff, at least yet. And then riskier bonds, these are junk bonds, and they tend to follow what's going on in the stock market. When this is going up, that means the riskier bonds are outperforming more conservative bonds like government bonds that don't have any risk. When this is coming down, that means now the riskier bonds are under pressure too, and that's more negative for the market. Then here's some areas that we're just keeping an eye on. We want to watch how the employment situation is. Now, we just had the report on Friday. It came in strong, but the numbers from the previous months were revised down. And we'll see how that goes. Now, that's a bit of a lagging report that we get. A little more real-time report is every week on Thursdays, we get weekly jobless claims. This actually went down in the latest reading, but what we really follow is the 4-week moving average, which is also going down. For right now, it just means the employment situation is holding up, because if we are going to go into a recession, employment's probably going to have to fall apart first. And if that starts to really show some weakness, then that's going to just suggest that we will, in fact, go into a recession. And continuing claims actually came up a little bit, but we're just kind of near the high end of this recent range, a little bit above it right now. And we're going up with the moving average. It's a little bit of a concern. This is folks that are unemployed for longer than 1 week. If this keeps going up, that's going to be more negative. And then this puts things together. We have the red line, the initial claims, the blue line, the continuing claims, and then the latest reading on unemployment came in at 4.2% unemployment. We're looking at the spread between risky and not as risky bonds. Now, you can see this is going up. That means fear is increasing, and we're concerned about that. But look at other times. This really spiked up. This was the COVID crash. And then this was a real downturn that we saw back in 2016. This was right around Brexit and right around the first time that Trump was elected. This was during the great financial crisis. So we are concerned that this is going up, but it's not too bad, at least yet. This is just showing an increase in fear in the bond market. And what I did on this next chart, it was actually put out by David Keller from stockcharts.com. He shows the same scale, but he inverts it. So when this is going down, that means fear is increasing. We still have some room to run before it gets really bad, but the fact that this has been coming down is something that we have been noticing. And this is inverted to match up more with what's happening with price in the S&P. And then we also have an inverted version of the VIX, which is just really cratering here, which means it's really going up in real life. Then we look at some ratios between stocks and bonds. When this is going down, that means bonds are underperforming. Not now. They're above both moving averages, and we're about getting ready to see a golden cross here. That means the bonds are starting to outperform stocks, and that hasn't happened in a long time. And they're actually positive year to date, and after gold, they're the second best asset class. Now, we're watching this. This is the mass index. This has generated a buy signal now, but we have no confirmation of that. There are three parts to the criteria of this chart. We go above the red dash line, that's one. We go above the blue line, that's two. And then we come back down to the red dash line again, that's three. Whatever happened to trigger this, which means we were coming down, the mass index anticipates that there will be a reversal. But we've been seeing this now for a few days, and we certainly didn't reverse on Friday, but we'll see if this turns into anything. I wouldn't use this all by itself. You need confirmation from other charts, but this is generating a signal right now. And we're also getting what's called the Pring Bottom Fisher buy signal. But this has been here for a few days now. It actually came up the latter part of March. But the longer that this continues to go up and the further away we get from this signal, the more irrelevant it becomes. So this is still on the books as a buy signal as well, but we're just not seeing any confirmation yet in the market. And I'm just watching this. This is probably considered positive. This is the 10-year yield that's been going down. Now, what we've been seeing lately is a flight to safety, folks getting out of stocks, going into bonds. And when they get into bonds, they buy bonds, which pushes prices up and pushes interest rates down. But that's helping. We actually dropped under the 4% level on Friday's close. At some point, if interest rates keep falling, the stock market's going to go, wait a minute. Yeah, interest rates are low. It's not going to cost as much for these small and mid cap and even large cap companies to borrow money. That means their earnings are going to be better. Let's jump over and buy some stocks. Well, we're waiting to see if something like that's going to happen. And now, you've probably heard a lot about these inflation fears. That's not what the market's telling us. If anything, according to the charts I'm going to show you here, we're looking at more of a deflationary type of an environment, which is different than inflationary. Looking at this is cash to 3 to 7 year bonds. When this is going up, that means there's uncertainty about interest rates. That means interest rates are going up, but interest rates have been coming down. And it means inflation's going up, but the CRB index, which is still in an uptrend, it got hammered with everything else on Thursday and Friday. Now it's still in an uptrend, but it's been getting hit pretty hard. And that's where we get some of our inflationary ideas from. You see, this ratio is actually going down right now. If the market was concerned about inflation and interest rates, this ratio would be going up. And so the fact that this is going down is talking more to deflationary pressures rather than inflationary pressures. And you're going to see a theme as we go through these charts. This is cash to 3 to 7 year bonds. These are tips, and these adjust for inflation and interest rates. When folks are concerned about inflation and interest rates, they get into tips, and then they outperform 3 to 7 year bonds. That's not what we're seeing happening here. Now, a week ago when I did this video, we looked at this chart and we were concerned about this because this was going up and this is in an uptrend. But with the big move down in Thursday and Friday's session, this ratio has really dropped down. This is not inflationary at the moment. Now it could turn and go back up, but for the moment, it's looking more deflationary. And then we look at tips, and then instead of 3 to 7 year bonds, we look at 7 to 10 year bonds. Look how it's really coming down right now as well. We are inverted with the 10 to the 3 month yield curve. Most people watch the 10 to the 2 year. That's still doing okay. That's not inverted. But the 10 to the 3 month, it is inverted. We're in this red area. That's a concern because once we come back to no longer being inverted, that's when we start to do a countdown to see if we're going to go into a recession. Now, we were inverted for a few years in here, and we went back to being normal. And to this point, we haven't gone into a recession, but now we're back to being inverted again. So we'll see if we finally get kicked out of this, what's that going to look like? How's employment looking? How are the economic reports showing up? Are we seeing inflation? Are we seeing deflation? We're just going to keep an eye on this. And then we look at oil, which this is not inflationary. It was at 69, it dropped all the way to 61. That's actually going down, and this will help gas prices. That's more deflationary than inflationary. And we want to keep an eye on the dollar. It had been really strong until we started 2025, and it's just been going down ever since. Getting close to a downtrend here and underneath its 200-day moving average. And just it went up, it got back up into the 102 range, but it was really coming down here lately. And then just keeping an eye on the German market because that's the strongest market in the EU. It's been one of the better performing areas. You see right here is the beginning of 2025, how it's been going up. Europe has been outperforming the US. Not lately. It came down with everything else. The whole world crashed on Friday. Maybe that was enough to put in some kind of a bottom. And then we look at a ratio of US stocks to German stocks. When this is going down, that means German stocks are outperforming. Well, this ratio is kind of settling down a little bit right now. So thank you. I hope you found this helpful. I hope you have a wonderful weekend, and I will talk to you in the next video.